Good morning, good afternoon, good evening to everyone online around the world. And welcome to the final IPRA webinar of 2022. My name is Hazel Bateman and I'm President of the International Pension Research Association, or IPRA. Before we begin proceedings today, I would like to acknowledge the traditional owners of the land on which this virtual meeting takes place. I would also like to pay my respects to the elders, both past and present, and extend that respect to other Aboriginal and Torres Strait Islanders who are present with us today. I would also like to encourage you to join IPRA. So you can find details at iprassn.org. So after the meeting, please have a look at our website. Today's webinar will be chaired by Dr. Darius Stanko. Darius is head of the International Organisation of Pension Supervisors IOPS Secretariat, which is hosted by the OECD. And Darius is also a member of the IPRA Executive Committee, which includes people from CEPAR, the OECD, IOPS, NetSPA, and the Pension Research Council. So I'd now like to hand over the meeting to Darius, who will chair the webinar. So Darius, the floor is yours.
Thank you, Hazel. Hello, everybody. Probably for most of you, it's good morning or good evening. For me, it's evening. I'm very delighted, very pleased to join this event and to moderate the presentation by Professor Susan Thorp, who's a professor of finance at the University of Sydney. She's researching area related to consumer finance with some focus on retirement savings. She's using both theoretical and empirical and experimental techniques to test consumer responses to advice, disclosure, and choice architecture. So this is very useful for the topic that we will be discussing today. So her research has been published in many international academic journals like Management Science, the Review of Finance, the Economic Journal. And also Susan was lucky to attract quite a good funding for her research from various public and industry sources. And Susan is a member of the steering committee of the Mercer CFA Institute Global Pensions Index, also a member of the research committee of the OECD International Network on Financial Education, which is INFE, and the director of Super Consumers Australia. So the plan is that I will give the floor to Susan, and then after the presentation, we're gonna have the discussion. I would like to encourage you to ask questions, or if you don't want to forget your question, you can send them in the chat and then we can collect them. And I presume that Susan might be open to having some very important questions during her presentation, but I will give the floor to Susan. Thank you.
Thank you very much, Darius. I'll just share my screen. I go to say good morning, but as Darius has said, for many people in a room, good evening. Thank you very much for joining the webinar. I'd like to introduce the men in the high visibility shirts in this picture. They're participants in the retirement plan for construction workers in Australia that's called CBUS. As you can see, they're overwhelmingly male. They also earn lower than average incomes. They're more likely to die or become disabled than other workers. They tend to retire early and with smaller retirement accumulations. And our research team from UNSW and the University of Sydney worked with CBUS, this retirement plan, to test whether we could help the participants keep track of their retirement accumulations better. This project included George Smirnis, who was a PhD student at the University of Sydney, now working in the finance industry in Australia, Hazel Bateman, who you all know, Isabella Dobrescu from the School of Economics at the University of New South Wales, and Ben Newell, who is a professor of psychology at the University of New South Wales. We'd also like to acknowledge the support of the Australian Research Council, who in partnership with CBUS itself funded this project. As many of you know, most people reach their pre-retirement years without ever really having figured out what to save for retirement and unclear about whether they're on track to maintain their well-being after work. Most people who are members of defined contribution plans only have regular reports of their account balance to go on, and that was true in Australia until fairly recently. This left everybody with the thorny problem of compounding up from a retirement balance to some amount of a savings or an income stream by an estimated retirement date. At the same time, what will be adequate savings varies a lot between individuals, as we know. So it's also the case that simply raising default or mandatory contribution rates can fail to account for possible impacts on wages, possibly reduce liquidity for some households, and possible restrictions on consumption smoothing. So mandatory responses to adequacy are not always ideal from a welfare perspective. As we know, pension regulators have begun to support and in some cases prescribe information for participants that helps them translate or project retirement benefits into the future. So the US Secure Act, which I understand is not a projection, does require plan administrators to include lifetime income illustrations of participants' account balances in benefit statements. The UK also requires occupational pension plans to give members an illustration of what their pension plan could be worth at the member's anticipated or agreed retirement date and what this could mean for their estimated retirement income. So the UK standard is forward-looking. The EU had issued a directive in 2016 that plan participants should receive retirement benefit projections. And Darius's own organisation, the International Organisation of Pension Supervisors, has recently issued good practices for designing, presenting and supervising pension projections just quite recently in the past few months. Now, it's a case that many jurisdictions support single scenario, deterministic and individualized retirement projections. And the example that we're studying in this paper is it takes those characteristics. So here's an example of what the pension regulator in Australia settled on in terms of driving retirement projections at the time. Since we did this study, practice in Australia and regulation has been under review, and restrictions implied by this formula are gradually being loosened. But this is what we were working with at the time, and I think there's certain benefits and merits in this approach. In 2014, the regulator in Australia allowed plan participants allowed plans to send participants projections of retirement balance and 25-year income from age 67. So age 67 is the target for the projection. Now, there's no official retirement age in Australia in almost every instance, but 67 is the age when most people will be able to access the public age pension. So that's why they chose that age. Now, if you look at this formula for projected balances, which is the left-hand side target of the calculation, the formula for projected balances is computed recursively, where each year the balance grows at a deterministic 3% real rate of return after fees. The mandatory contribution, which at the time we did this study was 9.5% of earnings and has since risen from there, that is then added along with any additional contributions, and any related administrative fees are deducted. And then this formula assumes that whatever my pattern as a plan participant has been over the past 12 months in terms of contributions and fees will continue until I reach retirement age. Now, there are some sensible exclusions that allow for unusual events, but basically the idea is that what I've done in the past 12 months and what the plan has done in terms of fees will continue, and that my contributions and account balance will grow at a 3% real rate of return. Now, it's also the case that the income stream that's associated with this projection amortizes the retirement balance at age 67 at a 3% real rate of return, and it includes an indicative amount for the public age pension. Now, the two areas of discussion that have come up in the review of this formula have, unsurprisingly, I'm sure to the audience, related to the assumptions about rate of return and the assumptions about public age pension entitlement, which in Australia is means tested and can vary substantially between individuals. So you can see from this formula that this is indeed a single scenario, individualized projection of retirement assets and incomes. Both things are projected. Now, we were very fortunate in being able to study results of a field trial that was conducted by CEPAR of this projection, actually beginning in the year prior to 2014. So since this projection is actually a straightforward translation of current balance and contribution information, in theory, it shouldn't be giving participants new information. So we use the field data to test whether this projection information motivates participants to help them engage with their plans more and potentially helps them think about their retirement preparation, whether it motivates changes to voluntary savings in addition to the required contribution level, the mandatory contribution level, and whether it appears to operate differently on people with different characteristics. And to some extent, to a little extent in this data, we can assess whether the effects are durable. We have 2 years of trial data that I'm going to present to you today, where there is both a treatment and control group, and allows us to make some more robust causal statements about the effect of the information on plan participants' behaviour. We also use an online experiment to test whether just one of balance and income projections is needed to encourage people to whether both cause people to change their behaviour, or whether only one of those information formats would be sufficient to motivate changes to behaviour. So in our online experiment, in addition to the field trial, I'll present the results of the online experiment in the second half of this presentation. We also test for variation between projection formats in people's behaviour. But of course, these online trials are hypothetical. Okay, so let's get into the trials that were conducted by CEPAR. So CEPAR is a large, what we describe as profit for participants, so a not-for-profit pension plan, and it mainly serves the construction and building sector in Australia. Now, the design of the trial that CEPAR undertook was not fully randomised. So we've had to do some matching work to improve our inference. Now, CEPAR thought that about half of their approximately 700,000 accounts would be ineligible to receive projections. For example, participants who had been with the plan for less than a year, or who were retired, or who showed very large one-off cash flows. So as we discussed in relation to the formula, those large one-off cash flows, we wouldn't want to project those as if they were going to happen from now until age 67. So certain groups of participants, CEPAR deemed to be ineligible. So that, for a start, reduced the number of accounts that they were prepared to consider as potential candidates for the projection trial. Now, in 2013, in the first year of the trial, CEPAR selected about 19,000 eligible members to receive the projections. So the treatment group in 2013, of the 355,000 accounts that CEPAR deemed potentially eligible, they randomly selected a treatment group of around 19,000 accounts to receive the projection. Now, the plan then assessed that these projections were pretty successful in terms of member engagement and other reactions. And in the next year, they sent then projections to all of the eligible members except for $20,000 randomly selected accounts. So the trial uses a randomly selected treatment group in 1 year, the first year, and a randomly selected control group in the next year. So we have 19,000 treated members in 2013 against a very large control, and 20,000 control in 2014 against a very large treatment group. So this is not the standard design that we would use if we were conducting a randomized control trial, but we do have random assignment in each year. It's just that the random assignment is based on different characteristics of the members. So randomly selected treatment group in 2013, randomly selected control group in 2014. So now this is an example of a section of the projection that was sent to members. The first box shows that the projection of the retirement account balance and states that it is not a guarantee. It's very clear about the fact that this is an estimate or projection. And it sketches the calculation method so that people have some idea on about the basis on which the information is being presented. Box 2 shows the 25-year income stream projection, including the age pension approximation. So you can see in box 2 that the assumption that they included in this projection was that the member of CBUS would be eligible for half of the government age pension from the time that they retired at age 67. Now, those of you who are somewhat familiar with the Australian retirement income system will know that the age pension in Australia is means tested by assets and income. So eligibility for the age pension depends on accumulated assets and income at retirement. However, at the same time, it's true that more than 70% of everyone over the age of 65 in Australia receives a part or full age pension, and around 60% of people over that age receive a full age pension. Given that CBUS was sending this information to a group of people who would be retiring with not particularly large retirement accumulations and who were unlikely to have sourced very large amounts of assets outside their superannuation account, this assumption of half of the government age pension is probably quite close to what people would actually see. Now, CBUS would like to, I know from discussions with the fund, would like to vary that assumption so that as people's accumulations declined during their retirement, their age pension intent eligibility, which because of the means testing, would increase, could be enlarged in the projection. But as a basic projection tool, and given that they're aiming for a lump sum at age 67 as well as a retirement income stream, this is what they settled on in terms of the interaction with the public age pension. Now, boxes 3 and 4 include calls to action. Box 3 encourages people to contact the team at CBUS, and box 4 proposes strategies for participants who want to respond to the information, and these include adjusting investment strategies and contributions, consolidating any duplicated accounts that the member might have, and then we have a picture of Justin and his little family in the box as a case study of how members might react to the information. So CBUS would be, I've got to say, embarrassed that I've shown you this particular format for their pension projections. The marketing team now cringes every time they see this slide because they've made so many modifications and they consider improvements to the way that the pension information is presented. And indeed, it's much simplified and clearer, in my view, in more recent rounds. And Justin himself proved to be extremely unpopular with his peers in CBUS, and he's been deleted. But we quite like Justin, so we keep showing him. Okay. So let's talk about what we did to manage the unusual design of this trial. So as I said, the trial allows 2 treatment groups matched to a 2014 control. So to measure the effects of the trial, we needed to create several matched samples that accounted for the limited treatment group in 2014 and the limited control group in, limited treatment group in 2013 and the limited control group in 2014. So we first matched the 2013 group with the 2014 control group using characteristics based on characteristics of participants before the 2013 trial began. And after we'd done that, we found we had a balanced sample of 9,649 members. So the small treatment group in 2013 matched to a much larger control group in 2014 from the same control group that was held out. We then matched the sample of people treated for the first time in 2014 with the control group from the first round of matching, but based on the characteristics before the 2014 trial. So we needed a control group who were not treated in either year, and we needed a control group who were treated in 1 year and not the other. So this gave us one group of people who were treated for 2 years in a row, those who were treated in 2013 and 2014. And it gave us a control group who were treated in neither year. And it gave us a treatment group of those who were treated in the second year, but not in the first year. So same control group for both instances, but two different treatment groups, one that had been treated twice and one that was treated only once. So 2013 treatment matched to 2014 control, 2014 control matched 2014 treatment matched to 2014 control. So altogether about 9,650 people in each group. Okay. So just to give you some evidence that the matching works, we can show you the characteristics of the treatment and control group by median and mean. The ticks under the F-test column show that these are insignificantly different from each other against observable characteristics. So the observable characteristics in the pension plan are not very large, but we do see age, gender, tenure with the plan, account balance, and we match against each of those 4 characteristics. So compared with the Australian population, this pension plan has slightly younger, slightly lower average account balance members, but they're not very far off the typical features of Australian pension plan members. Sorry, I'm sorry, I was a bit distracted at that point by a phone call. Nobody's trying to contact me from the control room, are they? Okay. So the types of participant interactions with the plan that we can observe and then report on is shown in this table. So we look after the participants in the plan were treated with this projection information. To evaluate the trial, we're going to focus on 2 types of participant behaviour. The first is interaction with the plan, and the second is extra contributions. So people can interact with the plan via email, phone, or in-person visits to the plan offices, which sounds like it might be unusual, but is less unusual than you might think because of the location of the plan in a major city. CBUS classified these interactions into general account inquiries, such as questions about balances, advice, say going to the plan for advice about making contributions or switching investment options, into queries about employers, and these will usually be plan members asking about what they consider to be unpaid contributions by their employer. There are instances where some third-party agent was acting for the participant, and also some administrative inquiries, such as questions about insurance or benefit claims. So this table breaks those down into their different categories, and you can see that by far the majority fall into the category of inquiries about accounts. But there's plenty of inquiries also asking for advice and administrative inquiries about other matters as well. So in total, we can break these down into their separate components and look at them, but we're actually going to focus on interactions as a group. We did the analysis in the background looking at the different categories of interactions, but we actually found it wasn't terribly informative. So what I'm going to show you this morning is really focused on interactions as a whole. So as I said, also the other thing that we're measuring here in the trial are types of savings contributions. And what we're reporting on in terms of the effects of the trial are changes related to voluntary contributions in excess of the mandatory 9.5% contributions that plan participants made. So as I said, in Australia under the superannuation system, most employees are required to have mandatory contributions made on their behalf by their employer, and this is what's called the superannuation guarantee. So this is a taxation structure that's put into place to compel employers to make contributions to the retirement plan. The amount of these contributions at the time of the trial was 9.5% of earnings, the earnings that the employer could see, of course. So it's possible also that participants in this plan have other employers who are making contributions either to other plans or into other accounts. And there are taxes on those contributions at 15%. In addition, there are two different types of voluntary contributions that participant can make. And we've described these as tax preferred or fully taxed. The tax-preferred contributions are taxed at the same concessional rate as the mandatory contributions, which is 15%. And these are limited to a maximum amount of $25,000 per annum per person, and including the SG contributions. So if your employer is making superannuation guarantee contributions on your behalf, you can make additional tax preferred contributions, but only up to a total of $25,000 per year. And this is usually done via payroll. So once a participant has decided that they'd like to make these contributions, they usually make them through the payroll system at their employer. So the setup is somewhat costly in terms of frictions, but the actual rollout of this, it can be done quite regularly and automatically once it's set up inside the payroll system. Now, for most people, there are some obvious tax advantages to setting up the tax preferred contribution type. And I would imagine that the plan in its advice would steer people in this direction where they're eligible to make them. Now, in addition to that, members are able to make taxed contributions, so they can pay out of their post-tax earnings. So the tax on contribution from your post-tax earning depends on your income tax rate, which varies from 21 to 47% for people in this trial. There is also a statutory limit on the number of post-tax contributions that a member can make into their plan account at $110,000 per annum. So that's quite a generous cap. And this can be also set up from a payroll system or done directly. So a member can just make a transfer from their bank account into their superannuation account in this way, subject to the $110,000 cap. So in our trial, we're measuring changes in these two categories of contributions because they're the ones that the participant has control over. And they're not automatic in the way that, and mandatory in the way that the superannuation guarantee contributions are. This is where the decision making comes into play. So let's have a look at what the trial did in terms of treatment effects. So I'm going to start by talking about the effects on participants' interactions and voluntary contributions in the first period after they saw the projections for the first time. So they may have received projections in, say, September, and we measure their response to those projections over the subsequent really 9 to 10 months to the end of the next financial year, which in Australia is at the 30th of June. So people were receiving projections in the third quarter of the year, and we measure their response up until the end of the second quarter in the subsequent year. The average treatment effects at first treatment, you can see where the treatment effect is highlighted in bold here, the effect is significantly different for the treatment group over the relevant control group. Now, the most marked effect of the projection information was to increase the percentage of participants who interacted with the plan by email, phone, or visit. So 13 percentage points more of the treated group contacted the plan subsequent to getting the projection, and the average number of interactions made with the plan by each participant was almost 50% higher. So initially, the impact of the projections on interaction with the plan was quite large and marked, and I think something of a surprise even to the plan itself. For the group that were first treated in 2014 rather than 2015, about 2 percentage points more participants contacted the plan, and again at a higher rate of interactions, but the differences are quite marked between first treatment in 2013 and first treatment in 2014. Now, the difference in size between these two first-time treatments could be related to some workplace spillover information for participants that were treated in the first round. CEPAR also found that the types of inquiries from the treated group tended to be likely to be more specific and related to advice. Now, the potential for spillovers is actually quite interesting in CEPAR. As you can imagine, many of the plan participants work on large construction sites where there are actually hundreds of construction workers all in the same place, and most of them will be members of this particular pension plan. And for that reason, the plan itself supplies representatives who are basically assigned to large construction sites and visit them usually weekly to interact with the pension plan participants and talk to them about any issues or problems that they might have, sorting out insurance issues or helping them deal with the processes around their pension plans. And this is very personal, very individual, face-to-face advice. So I can well imagine that it would be hard to prevent people talking to each other about the differences between the information that they were getting if treatment and control group people were on the same site. So there's potentially some spillover from the 2013 group into the group that were first treated in 2014. Now, we also see increases in the rates and amounts of voluntary contributions. So the percentage of treated members making extra contributions is 12% higher than the control group for the 2013 treated group, and about 5% higher for the 2014 group. The amounts of contributions were also on average higher, so around 45% higher in each year. So we conclude that the treatment increased the number of participants who made extra contributions, but the effect was especially marked on the size of contributions made by people who made them. So the treatment effects of the tax-preferred voluntary contribution was higher for people at lower balance, and the effect for the fully taxed contribution was stronger at older ages in terms of heterogeneous treatment effects. So conditioning on making the contribution, now these effects are not large the way, in the way that most nudges are not that large. But if we condition on making the contribution, if those who made these increases then continued them to retirement, they actually amount to about an extra year's median wages in accumulation at reasonable rates of return. So for those who were adjusting their behaviour, if they persisted over their working life, the effect on their retirement balances were potentially substantial. Okay, so let's turn to the effects on interactions and contributions in the second year of treatment. Now, these are people that were treated in 2013 and again treated in 2014 compared to a control group that wasn't treated in either year. So you can see that although the proportion of treated participants who interacted with the plan was significantly higher for the control group, and that the number of interactions per plan participant was also higher in the treatment and the control group, the differences are smaller than they were in the first year of treatment. Now, the rate of voluntary contributions was higher again, and the average amount still substantially higher in the second year of treatment. So this suggests to us that the effect of the projections was not limited to the first year of the trial for those who received it twice. So it appeared to change behaviour for at least 2 years in a row. So on this question of, we obviously have very limited data on the question of the durability of the effect, having 2 years and, a relatively limited treatment group. But what we can say, and you can see this in the pie chart, is that the durability of the contribution patterns over the 2 years of the trial were actually quite substantial. So 70% of the treated contributors made contributions in both years. And we found that around 17% made contributions only in the first year, and another 13% began making extra contributions in the second year of the trial. So there were a group of people who didn't respond in the first year, but did in the second year. And then there are another group who did attrit between the 2 years of the trial, but 70% of those who contributed did it 2 years in a row. Now, the durability of interaction, increased interactions was much less. So among the treatment group, about 40% made contact with the plan 2 years in a row, about 1/3 only in 2014, and about 1/4 only in 2015. And we speculate that the projection did encourage people to inquire the first time they saw it, and then these people had the information that they needed probably, and perhaps they had acted on it. So this also raises the question of how interactions and extra contributions related to each other. So we were interested in whether the extra contributions were dependent on the participant having interacted with the plan to get advice about how to do that, how closely connected the two activities that we were observing were related to each other. And these results were somewhat surprising, I think. So the impact of projections on participants both contacting the plan and making extra contributions as shown in this table. And you can see that in the first year of treatment in 2013, the percentage of participants that took both actions was 5.85% compared with 3.68% in the control group, or about 60% higher in the treatment group. And this double action was about 20% higher in the second year of the trial. So in the second year, we had 4.73% compared with 3.96%. But on the other hand, a majority of participants who took an action took only one action. So around 55 to 60% of those who added contributions did not contact the plan, and more than 80% of interactors didn't contribute. So they were actually much more separate than we had hypothesized they might be. Most participants took only one action, but the treatment does significantly raise the likelihood of taking two. Now, this may be an indication that people use the prompt to ask for information about other sorts of behaviours in the plan, and that didn't show up in voluntary contributions, or they contacted the plan and were reassured that their contribution pattern was satisfactory for them. It's also possible that the information in the document itself was sufficient for people to figure out how to make their own additional voluntary contributions if they wanted to. So while we do see some sort of correlation between these two actions, they're also reasonably independent from each other. Some of you are probably thinking at this point, why hasn't she said anything about investment switching? because obviously the information that was given to participants allowed people and encouraged them to take a look at their investment strategies as well. And the answer to that is that hardly anybody did. So we observed in the data that there were very few treatment-related reactions to this information in terms of investment switching. There was only about 100 100 different participants who made changes to investment strategy. And most of those really just moved into the default fund, which is quite highly exposed to growth assets. Typical default funds in Australia are strategic asset allocation options with 70% in growth and 30% in defensive. And so really, I'm not presenting investment results because they were so small. Okay, so this leaves us to sum up the effects of the field trial, and I'll pause here for a minute to see whether anybody has questions or clarification before I move on to the discussion about the online experiments. So the projections, on the basis of what we saw, the projections of future balances and 25-year incomes did boost participants' interaction with the plan significantly and raise the rate and quantity of savings among the treated groups. The participants that make contributions continue to do that in the second year, or the majority of them do, and that suggests some durability of the treatment effect, especially considering that around 2/3 of those who contributed did that for 2 years. So this opens the question for plans and regulators is what projection format should be implemented here? What's likely to be most helpful to members and help them guide their own judgments about adequate retirement accumulation. So an obvious question here is whether both future balance and income projections are needed, or whether just one of those would do. So we ran experiments to test the format that I'll go on to talk about next. So our online experiment was conducted around the same time, and we basically allowed for 4 treatment groups that you can see described on this slide. We wanted to test the effectiveness of the different formats, as I said, and the experiment gave retirement plan members the opportunity to choose to save more should they wish to. We divided them into age groups, and within each age group, we randomly assigned them to 4 different treatment groups, one that received only current balance information, one that received the lump sum projection and current balance, one that received the income projection only and current balance, and one that received both the lump sum and the income projection at current balance. And we asked them in a sequence of 10 choices that had a recursive structure to choose what they would contribute from their extra leftover income, which we described to them. So I'm going to skip these a few slides, and just show you the outcome of this experiment. So people were asked, would they like to contribute more? We described to them what their disposable income might look like for a median household of their age. And we asked them to make this decision 10 times between their current age to their hypothetical retirement age. And each time we offered them the choice, we updated their balance so that it reflected previous savings choices that they had made in the past, plus investment returns, plus mandatory contributions going into their account balance. So they saw the natural growth of their account balance, natural in the sense of somewhat based on the default and mandatory structures. And then we gave them the option to save extra based on the information treatment that they were given. Now, in this graph, you can see that the average percentage of discretionary income that people in the experiment saved. And the important thing to notice is that the treatment is significantly higher than the control. So the control group, which is the current balance group, is indicated by the dotted line at the bottom. And you can see that each of the treatment groups, when any projection information was given, whether that was the income stream alone, the lump sum alone, or both of those together, all raised the average extra contributions that were made by members during the experiment. Now, over the successive treatments, so as I said, in this experiment, people made a savings choice 10 times in which they moved from their current age to their hypothetical retirement age, so from now to age 67. And the results are summarized really in this table, and that is that in terms of percentage increase in retirement balance after 10 choices, the only statistically significant increase that we observed in the experimental setting were for members who saw both the lump sum and the income projections together. So there were increases among those who saw the lump sum projection and only, and those who saw the income only, but these were not significantly different over 10 choices from the control, but the two information projections together did make a more durable effect. So we also found that there was higher savings among participants that had higher education, who had better knowledge of the retirement savings system, who had less risk aversion, higher bequests intentions, and lower financial literacy. So in terms of heterogeneous treatment effects, that summarizes the ones that we observed in the experiment. So people who had, say, more confidence perhaps in the retirement system itself, so better knowledge of the system, were more cautious, wanted to leave a bequest, perhaps were better educated, but interestingly, the more financially literate did not choose to increase their savings, and quite possibly that's an optimal decision. So our theory around this is that there's a reference dependence effect related to these projections. The lump sum feedback that people get through the experiment is large relative to income. So as you do the experiment, you see this lump sum expanding in quite a visible way. The income feedback tends to look fairly small. So as I add to my savings, the increase in my post-retirement incomes are not so visible and large. And we hypothesized that the combination of the lump sum feedback, which is quite positive for people that are savings, and the cautious feedback that comes to them through the income framing is something of a carrot and stick operation in terms of people's behavior. So we actually found, contrary to the field trial, that in the online experiment, that these projections were more effective for younger participants than they were for older participants. And these younger participants, obviously within the experiment, get the benefit of longer compounding periods. I'm just going to skip this next section because we've run out of time, but I do want to note that we observed considerable heterogeneity in responses among the participants in the experiment. So in the experiment, around 22% of participants in the experiment did nothing, changed nothing, made no extra contributions. About 10% consistently increased their savings. About 17% started low and then increased their savings rate as they approached hypothetical retirement. About 8% did the reverse. So started off saving more and then decreased, and 43% made variable changes throughout the experiment. So we see a lot of variation in response within our online experiment group. So we basically find that feedback matters over time, and this is potentially an effective way to raise contribution. We also found that the budget information that we gave to people in the online experiment apparently helped them make savings decision, but we also observed quite a wide variation in savings intentions. So just to sum up here and draw this presentation to an end, I think that from the field trial and the online experiments, we find that projections help some participants to plan, but format is very important and most likely important to durable effects. So reframing account balances as projections increases engagement with the plan and increases voluntary contributions, and we observe an effect that continues over 2 years in this trial. We're testing personalized projections, so this is not generalized information about possible outcomes. The effects are larger and more persistent than earlier studies of general information about possible outcomes. And our supplementary online experiments confirm that the combination of lump sum and income projections is the most effective way to present this information. So I will stop there and turn back to Darius to go to the floor. Thank you.
Thank you, Susan.
Yeah.
I would like to thank you for this excellent presentation. Thank the audience, and I will give back the floor to Hazel. Thank you.
So thank you very much. Thank you very much, Susan. Thank you very much, Darius, for chairing. And thank you to our terrific audience again.